Why aren't we celebrating the June inflation numbers? What do the inflation numbers mean for November I-bond rates? And what might change the Fed's potential rate hike decision later this month? Hello, Super Saver. I hope you're well this week. These are the 3 questions I'll be answering in today's video. Here's our front of video disclaimer as usual before we dive in. For a detailed disclaimer, please refer to the end of this video. According to the Bureau of Labor Statistics release of the latest inflation numbers this week, CPIU in June 2023 increased 3% over the last 12 months. So basically, we're here on this blue line. Compare this to June 2022, when CPIU increased 9.1% year over year, the biggest increase in over 40 years. This 3% year over year increase in June 2023 was also the smallest 12-month increase since the period ending March 2021. It appears that food away from home, shelter, and transportation services were the primary drivers of the year over year increase, balanced out by these significant declines driven by gasoline and fuel oil. Which brings us back to the same issue that we've been seeing before. Yes, overall inflation, as measured by the annual increase in CPIU, this blue line here, has come down. It's come down a lot, in fact, over the past year. But core inflation, this red line here, hasn't really come down that much and now stands at 4.8% year over year. As a point of reference, core inflation in the years between 2013 and 2020, just before COVID hit, averaged about 2% annually, and Fed Governor Powell at a recent European Central Bank forum told the audience that he doesn't see 2% core inflation before 2025. And fun fact, or not so fun fact, depending on whether you're a super saver or not, on July 12th, the Bank of Canada raised its key interest rate to 5%. This was the 10th rate hike since March 2022, and the first time since April 2001 that the figure hit 5%. In fact, central bankers across the globe are expecting the slog to a 2% inflation target to be, well, a slog. So personally, I think we're not quite out of the woods yet. And I'm still standing by my expectation that there will be further rate hikes this year. It's still quite a way from a 4.8% core inflation to the Fed's 2% target rate. And it seems quite a few of the members and super savers in our community feel the same way. Based on this recent poll that we ran, some of you even seem to think the Fed will hike 50 basis points. I'm not so sure about this one, but hey, you never know. More on this later. So that's core inflation, what central bank leaders and policymakers look at. But we, you and I, we have to eat and we have to drive. So let's get back to the overall CPIU, which does take into account food and energy prices. CPIU is also particularly important in this community, given that it's used to determine our May and November I-bond rates, which is a great segue into the next section of our video. So, the CPIU number at the end of March is the starting point for the November 2023 I-bond variable rate calculation. And currently, we have only 3 out of the 6 months of data that we need to complete the calculation. Here are the inflation numbers for April. Here are the ones for May, and here are the ones for June, which brings us to a 3-month percentage change in CPIU for all items of 1.08%. This translates into a projected annualized I-bond variable rate of 2.16% for November 2023, assuming there's zero movement in overall prices for the next 3 months, which is unlikely. We've gone through the next chart before, but let's do a quick refresher anyway. If we take a walk down I-bond memory lane between 1998, when the I-bond was first launched, up until last year, 2022, this blue line shows the CPIU percentage change between September of the previous year to March of the designated year. Basically, the semi-annual inflation rate that would be used for that year's annualized May I-bond variable rate. And this yellow line shows the CPIU percentage change between March and September of the designated year. In other words, the semi-annual inflation rate for that year's annualized November I-bond variable rate. In about 70% of cases, the semi-annual inflation rate between March and September of the designated year was higher than the semi-annual inflation rate between March of the designated year and the previous September. Meaning, in 70% of cases, the annualized November I-bond variable rate was higher than the annualized May I-bond variable rate in that same year. So, for 17 out of 25 years between 1998 and 2022, the annualized November I-bond variable rate was higher than the annualized May I-bond variable rate in that same year. Unfortunately for us I-bond holders, of the 8 years when this was not the case, 3 were during or in the aftermath of the dot-com bubble burst, 4 were in the aftermath of the Great Recession of 2008, and 1 was during our current crisis when inflation started peaking at around this time last year. So, based on this analysis, the latest inflation numbers, and the Fed's inflation fighting efforts, I'm sticking to my prediction that the annualized I-bond variable rate come November will be lower than the current annualized I-bond variable rate of 3.38%, and that the fixed rate will be around 1%. As I've said before, no one really seems to know how the Treasury sets the fixed rate on I-bonds. But based on what we've seen, it appears that the I-bond fixed rate does more or less track the real yield on tips, usually with a bit of time lag. And the real yield on 10-year tips has held its ground over the past month since our last inflation and I-bond update, as you can see here. In fact, the 5-year tips even briefly crossed the 2% real yield mark before the latest round of inflation numbers were released. If the fixed rate on I-bonds and or the real yield on tips do keep trending upwards, we may need to revisit our strategy for the inflation-protected portion of our personal portfolio. So, stay tuned as always. Now, let's talk briefly about what's happening the rest of the month that could change these predicted numbers, as well as the Fed's rate hike decision at their next meeting. It's earnings season. In fact, 4 of the 8 G-SIBs in our country, the global systemically important banks, JP Morgan Chase, Citigroup, State Street, and Wells Fargo, are reporting earnings this week. The current expectation is that the biggest banks will be okay, with some seeing stronger numbers than others, but overall holding their ground. The regional banks, which will be releasing earnings a bit later in the second half of this month, these regional banks, however, are keeping a lot of us in the industry at the edge of our seats. If deposits continue to flow out from these regionals, and or if their numbers are simply worse than expected, we may see a bit of a repeat of the banking turmoil from earlier this year, which will most likely have an impact on the Fed's rate hike or skip decision at the end of this month. As always, stay tuned for more. We'll be watching this space. Now, despite the uncertainty and noise out there right now, there's still a lot of opportunity in the world of fixed income in my mind, if you're in the right position to take advantage of it. In fact, I think things are just starting to get interesting. Check out this latest video on agency bonds for those of you who want to learn more. And for an even deeper dive into the world of bonds, check out our latest members-only videos and join our monthly live member Q&As. Visit our channel page or the joint link in the video description below for more details about Diamond NestEgg membership. All right, Super Saver, I hope you enjoyed this video and learned something new. And as always, if you did, don't forget to share it with those you care about and hit that thumbs up. And see you again very soon with more brand new wealth building content for your financial journey.